Welcome to the Credit Events Podcast, a podcast for credit-savvy investors. This podcast is for informational and educational purposes only and does not constitute financial advice. The opinions expressed by the presenters are their own and do not reflect the views of Destra Capital. Nothing discussed in this podcast should be considered a solicitation to buy or sell any securities. Listeners are encouraged to consult with a qualified professional before making any financial decisions. And now, here's your host, Rob Watson.
Hey everyone, and welcome back to this edition of Credit Events. I'm really excited for the topic that we're covering today. This is something I think is incredibly timely. And really, one of the things that we like here at Credit Events is bringing different and unique ideas to talk about. And this certainly is one of them. Whether you call this significant risk transfer or regulatory capital relief, it goes by a couple of different names. And our guest today is going to get into all of that. This is a topic that is just starting, I think, to pick up a lot of interest in the broader U.S. market space. And so it makes it incredibly timely here in May of 2025 to be talking about it. So with that, I'd like to introduce our guest, Dana Staggs. Dana and I became acquainted just a couple of years ago when we first learned about the strategy that they have over at ArrowMark. Dana is the president of ArrowMark Financial Corp. It's actually a listed closed-end fund, trades under the ticker symbol BANX. But what I find really fascinating is the core of the investment strategy that they have is off in a really unique part of the credit landscape. And so we're going to get to unpack that with Dana today. And I think all of you will find it fascinating as well. So Dana, welcome. We're really excited to have you.
Thanks, Rob, for having me.
Why don't we start at the top? I mentioned briefly regulatory capital relief trades, but as I said, there's a couple of different monikers for this. Can you just describe what are we talking about? Because I think a lot of people haven't heard of this.
Yeah, you're right. It's not something you hear about every day. Regulatory capital relief securities, you mentioned, some people refer to it as significant risk transfer. These are income generating investments. They're issued by big global banks. Think of banks like Citigroup, Goldman Sachs, Barclays. Traditionally, they've been more in the domain of institutional investors, but now through ArrowMark Financial Corporation, ticker BANX, Main Street investors can get exposure too.
So it's kind of opening the door to a part of the market that, frankly, is off limits to most, certainly to retail.
Exactly. And there are a few, things that really make it attractive. There's high single to low double-digit yields, relatively stable asset values, and low correlation with other investments. Unlike stocks and bonds you trade on an exchange, these are private, customized securities. Banks use them to manage how much risks show up on their books for regulators without actually selling the loans. That customization, we think, helps drive attractive risk-adjusted returns.
So, Dana, we haven't talked too much about the structuring of these yet, but you mentioned that this involves loans at banks. But this is unlike CLOs, where an investment takes the loans off of the originator and actually packages them. Can you describe that? The banks actually keep the loans in this regard, right? That was fascinating to me when you first educated us on that.
Yeah, they get to keep the loans, and a byproduct of that is they keep the client relationships, which is a big deal. Meanwhile, investors like us, we earn a fixed spread plus a floating rate return in return for assuming some of the risk that portfolio of loans that the banks get to keep. And, I'll refer to these as the reference portfolio. These reference loan portfolios we're taking risk on are typically diversified across hundreds or even thousands of loans, with credit quality hovering around BB positive to BBB minus on a dollar risk-weighted average basis.
So I'm imagining you talked a little earlier about the potential yield range on these. I'm imagining that's the big draw. It certainly seems, as we look at it, that yield is very attractive. But what else should investors think about?
Well, the yield is nice, but it's not the entire story. Investors also like these because of the stability of the net asset value and the low correlation to other asset classes. Plus, the floating rate gives you a bit of a hedge against inflation.
So that's a nice balance of features beyond just the yield number that a lot of people focus on.
Exactly. So when rates rise, long duration bonds usually get a valuation hit, but these are floating rate securities, so they don't behave that way since the interest rate increases in tandem with, a short term rate index. And the reference portfolio, they're very diversified across geography, sectors, and borrowers. At ArrowMark, we use a top-down actuarial modeling and a bottoms up credit research to analyze the risk. So we've got 11 industry specific analysts who dig into each of the loans in the reference loan portfolios.
You talked earlier about sort of the diversification and the fact that these act differently, kind of low correlation, I guess. Can you educate us a bit more about that?
Well, look, I believe they're pretty low. In the BANX earnings presentations, we typically show a 5-year correlation history to net asset value. And we took over managing BANX a little over 5 years ago and learned and leaned pretty heavily into regulatory capital relief securities. Since the payments float with short-term rates, the income stream can actually go up if inflation stays sticky and central banks keep hiking.
So I see the attractiveness of this as an investor, right? The potential for pretty strong yield, possible low correlation. You talked about the resilience in a rising rate environment because of the underlying instruments are reset, if you will, as rates possibly rise. There's a lot of attractiveness on the investor side. I guess a question then is, why do banks want to issue these? What's motivating them?
Good question. If you think back to the financial crisis, banks have steadily had to increase the amount of capital that they hold against their loans, which makes the bank safer, but also limits how much they can lend.
Hmm. So, I mean, raising capital is critical for anybody, but it can be expensive.
Yeah, and you're right. Equity can be expensive and hard to raise depending on market conditions.
Yeah.
Other
Yep.
other tools that the banks have, they can sell off loans that they don't care much about. And they do that. They do that with loans that are more commodity, less relationship oriented. So think of these as residential mortgages or car loans.
Right.
But when you think about your core corporate relationships, they very much want to keep these loans. And regulatory capital relief securities lets them do that. They allows them to manage their capital and keep the client, and free up room for the ability to lend more.
So it really is almost from a relationship standpoint, the bank now has a motivation because they want the recurring institutional relationship with whoever borrowed the money, the institutional that borrowed the money. So yeah, that's
It,
really fast.
yeah, I mean that's exactly right. And think about these. These are the core corporate loan relationships that the bank has to have. And what that does is it opens the door up for higher margin services. So think of it as M&A advisory services, underwriting, treasury management, you name it. These securities allow the banks to expand their client base and helps them drive additional revenue opportunities. We've been doing this since 2010, so right after the great financial crisis. And today the broader ArrowMark organization has who happens to be the advisor and the parent to BANX. Broadly speaking, on behalf of not only the public fund but the institutional capital we manage, we've invested over 10 billion across 120 transactions. um, it's not a space where you can just jump in. Banks need
Right.
partners
Yeah.
who know what they're doing.
Right. Yeah, it's kind of interesting as you describe it. That that core loan feature is almost a gateway service for the bank to then be able to hopefully win other business from the institution. You can see how strategically critical it is for them. Um, so this market space, you called it regulatory capital relief, right? How big is that market space, do you think, or what trends do you see there? How big do you think it'll be?
Yeah, it's definitely grown. It was about 14 to 16 billion dollars in 2022. It grew to about 22 to 24 billion last year. We think the value proposition for the banks is strong, so we expect supply to stay healthy going forward. Sort of going back to something you had mentioned, uh, the banks very much will view these securities as something that enables top line revenue growth. When regulatory capital becomes tighter and tighter as restrictions by the regulators continue to tighten, the ability to grow that client base has restricted relative to their balance sheet over time. And this product has allowed that balance sheet to free up. And so think of it more as a revenue generating opportunity for them. It allows them to maintain or even grow their client base.
You touched on this earlier, but as I'm thinking about it now from investor standpoint, and then the bank that wants to use this in the control of their capital stack, how are those two interests aligned?
It's a very key part of the security. I think it's one of the more attractive parts of the security. Um, as we mentioned earlier, some of the risk from a portfolio of loans is transferred from the bank's balance sheet to our investors in return for a floating rate return. Um, as a result of that, though, the people that manage the actual loans at the bank, think of it as the credit officers or the account managers, they typically don't even know that risk has been transferred, at least from a part of that portfolio, onto investors like that, like us. They view it as if they're 100% invested with bank capital in that borrower at all time. And so as a result, if things uh, turn out to go badly, they act as if that's bank's proprietary capital. They fight to get their money back, and that's a very big difference than one. If you think about selling off residential mortgages, for example, right, that risk has been completely transferred. In this, their mindset, they don't. A lot of the people who make the decisions don't appreciate that. In fact, some of the risk has been transferred.
That's interesting, and I think that's one of the things that at first it didn't occur to me, but the terminology is very specific, right? It's the risk that's transferred. It's not the actual loan. The loan stays with the bank on their books and is worked by the loan organization there. It's really just a risk element or a portion of the risk that is offset. That's really pretty. I mean, this is such a unique asset class, and I think that makes it so distinctive and different. People have learned a lot about structured credit over the years, CLOs, CMBS, some of the other things that you talked about. This is a very unique way of doing it. Kind of interesting. Do they ever keep the first risk loss at the bank, or does that go off to the tranche, or how does that work?
Yeah, so I think what you're alluding to is a lot of times they're transferring risk from a portfolio of loans, and we may take the first part of that risk, but in many of these situations, they're actually taking like a first risk loss of off the portfolio loans, and then we may come in behind them with a second loss, and then they end up taking the last loss on that portfolio loan. So there is some tranching that goes on there. But also, in addition to that, a lot of times, not the entire loan has had some of the risk transferred. A lot of times, they keep a pro rata strip of that loan on their own balance sheet so that whatever exposure, whatever hits that our investors may take, they'll also take on their balance sheet for a portion of the loan that's not a part of this security.
I think that gives people a lot of confidence because the bank still has skin in the game, right? It's not just that the bank has originated the loan, made the fee to create it, and now sold it off, and the risk lives with whoever the investor is. The bank very much wants that loan to perform, it's in that's the beauty of the structure. I think it gives you a lot of confidence that the banks are so driven that way.
Yeah,
Um,
they do. Look, it's in some cases the banks absorb a capped amount of losses ahead of our investors, and in others, banks and investors share the losses equally on retained loans that aren't included in the reference portfolio. So these securities are really a partnership based type of structure, and it keeps everyone's incentives aligned.
That's really fascinating. We could just talk more and more about this. In fact, we'll have you back again soon to talk more. I'm sure this is going to be a topic that I think a lot of the folks that listen to credit events are going to want to hear more about, and I hope they reach out to want to learn more. That's really fascinating. Dana, we always close with like one last question. As you think about 2025, which is shaping up to be an interesting year, what's the one credit event or surprise that you think investors ought to keep an eye on?
Look, I don't think this is going to be a surprise to anybody, but if I had to pick one thing, it's that we may be in a new era of what I would characterize as persistent uncertainty. And that could spill into everything. It could spill into growth, inflation, the markets. We are not trying to make big macro bets. We focus on finding investments that perform across a range of environments. I actually think regulatory capital relief securities fit that bill. In choppy times, steady incomes becomes even more valuable. And, with our high single digit to low double digit coupons, what I think is strong risk adjusted portfolios and diversified portfolios, we think we're well positioned to help investors ride out whatever comes next.
That's terrific, Dana. Thank you so much. We really appreciate the time you spent with us today. Fascinating regulatory capital relief. We'll have you back again because I'm sure people are going to learn even more.
Thanks for having me, Rob. Really enjoyed talking to you.
Excellent. Thanks, everyone.